fundsupermart.com.
Hi Michael. After a strong rally in 2013, Japanese equities did not have a good start and was one of the bottom performing markets in the first quarter this year. What are the reasons for the recent underperformance?
Yeah, thank you for allowing me the opportunity to speak today. 2013 was an interesting year for Japan. It was probably the first year in a very long time that investors have actually taken notice of Japan. And in fact, they've started to recognise Japan as for its really extremely cheap valuation. So, it did rally strongly, but from very, very low levels in terms of valuation and prices. So, given how well it did last year, it might not be seen as too unusual to see this market pause, especially compared to some of the other markets that lagged last year. I suppose when the question around what might explain this year's performance, well, if you think about it, there's been a lot of experts and commentators making quite a few comments around either external factors such as emerging market instability. You have questions or sentiment being affected by whether exports are going to be affected by that. You have other commentators saying there's domestic factors. So just recently there was an increase in consumption tax, and there was a lot of questions being asked about how that might affect the market. Now, those kinds of things are sort of information that people will use, and quite often they use it to make short-term decisions. And the market can herd around these kind of decisions, but it doesn't really explain market performance. So they tend to be quite simplistic, if you like. And obviously, market behaviour is not always rational. It's quite often more complex. What we think is important from our perspective is understanding that prices do move, and they can move to extremes, because investors do take note of this information, and they tend to herd around this information, and that drives prices. So prices are driven quite often to extremes in the short term, and for us that actually provides an opportunity. We're focused more on, if you like, sustainable earnings, understanding what a company might be worth or an asset might be worth, and what the fundamentals of this company are. So when prices are extremely dislocated from what a fundamental case for or the fundamental worth of an asset is, this is an opportunity for us to exploit. And I think more importantly, whilst market valuations are obviously less than they were at the end of 2013, I think the fundamental case is actually improving for Japan right now. This is something that we look at it from a bottom-up perspective, from a stock-by-stock perspective, and we see that there's just growing balance sheet health in the corporate sector in Japan. So just to underline, whilst prices may be cheaper today, I think the fundamental story is actually improving.
In that case, can you share about the fund's recent performance and the areas that have and have not done well for the fund?
Now, the fund did extremely well last year. It outperformed the market, and it's continued to do so into this year. So, just to give you some more background, I'd like to take you back a couple of years. I think that might be interesting from a contextual point of view. And if you think about the market dynamic in 2012, as bottom-up stock-picking managers, we saw, if you like, there was a big divergence and a growing divergence between stocks which were very expensive and stocks which were very cheap. The cheap stocks were getting cheaper, and the expensive stocks were becoming more expensive. This is the kind of dynamic that we'd like to exploit. And so we found a lot of opportunities, especially within financials. Some of the major banks were extremely cheap in terms of valuations and in relation to what we believe they could sustainably earn. There are also a lot of stocks which were out of favour with the market due to the global cycle at the time. So stocks that were technology related, for example, were very much out of favour. But when we looked at their, if you like, their fundamental case, we could just see that from a sustainable earnings perspective that they were very attractive. So during 2012, we were able to take on and build some big positions through those areas in financials and within the technology-related or global cyclical kind of stocks. Now, obviously moving into 2013, actually those stocks were the ones that did very well. The financials outperformed most, and some of the technology-related names that we held on a more stock-specific basis actually delivered some strong performance for us. Now, whilst the fundamental story or the reason for holding these kind of stocks are still intact, obviously prices had risen, and that gave us a good opportunity to take profit on some of the financials, some of the major banks, and also some of the technology-related names. So that was toward the end of 2013. But also, as does happen, opportunities do arise, and we found during 2013 there were some stocks within the sort of broader materials sector that actually became quite extreme in terms of valuation. So we took that profit from the financials and technology and invested it more into the materials names. So that takes us up into 2014, and what we found now is actually after such a strong and long run from financials, they've actually started to underperform this year to date. So from our perspective, we're quite counter-cyclical or contrarian in the way we think about investing. So whilst if you think two things can change for us is fundamentals or price, from a financials perspective, we saw that fundamentals were intact, but price had become more attractive. So in 2014, we've actually been adding back some of the financials. The stocks that have done well for us and delivered strong performance are in fact some of the technology-related names that we've been building, and some of the materials names, some of those new ones that we had from 2013.
One of your investment processes is identifying valuations anomalies that rose from short-term fluctuations and then taking advantage of these anomalies. What are the key metrics of identifying such mispriced opportunities?
Yeah, I think if you look at the way the market behaves, quite often you see a lot of these simplistic rationales that we alluded to earlier as being reasons to either buy or sell an asset. Quite often what that misses is quite often the fundamental reasons for owning a stock. Now, what we find is that, if you like, financial market timeframes don't actually equate to the real world timeframe in our mind, and investors in the market can often be very, very focused on the short term. And when investors use the same simplistic reason for investing, that quite often causes a herding behaviour and can drive prices to extremes away from the fundamentals. So from our perspective is firstly building a very, very deep understanding for the fundamentals for the stocks that we are investing into, understanding what's sustainable for the companies, and then understanding what the market's pricing. Quite often what the market is pricing is very different to what the asset may be intrinsically worth. So the key for us is if you like, to be aware of where the market's pricing is being driven and why, but also having a very, very strong discipline around understanding the fundamentals for a company. Only focusing on the biggest valuation outliers. So a valuation outlier are the ones that have the biggest difference between today's price and what maybe it's fundamentally worth over the longer term. By focusing on those valuation outliers, that gives us actually a margin for error, because what we believe is that forecasting is inherently very hard to do. Not many people can do it, and we believe that it's futile to do so. So we don't try to forecast, and we avoid putting any work into it. By having a big margin for error, that is an acknowledgement that we could be wrong in our assumptions, but it gives us that, if you like, the fat, if you like, in terms of what the potential returns are, and also gives us a chance to wait to get paid. So those things are very important to us, is building conviction, spending a lot of time doing our due diligence on stocks.
What are the biggest challenges and concerns that you face during stock picking?
I think on behalf of our clients, I think it's the risk of permanent loss of capital. I think that's the most important thing that any investor should be focused on behalf of their clients. And that's why we spend so much time doing such a deep due diligence on every stock that we invest into. Just spending the time to understand what would be a sustainable level of earnings for a company over the longer term, understanding what the market might be pricing, understanding why this stock might be out of favour for any reason with the market. And we because of the way we invest, we tend to be counter-cyclical, contrarian. So that does require patience from time to time. We won't know necessarily when a stock return may come to fruition, but by having, if you like, creating a big margin for error, only focusing on the valuation outliers, allows us to be patient and actually look through that short-term volatility which we're trying to exploit in the market. And if you look at what we find from a fundamental perspective, I think this is what really is the investment case for Japan right now, and that is, firstly, valuations are extremely attractive within the market. And from our perspective as investors who look for the extremes of valuation, there are now more valuation outliers, in fact, than there were a year ago. That implies that there are stocks in the market that are getting more expensive, and there are stocks that are becoming more cheap, and that's what provides us with the opportunity. But when we go and do that deep due diligence, what we're finding are two very important things, and I think these are the following things have not really been priced into the market yet. And that's firstly the really strong balance sheet health of corporates in Japan. They've been going through a very long period of debt deleveraging, paying off debt, looking at exiting non-core businesses, focusing obviously on their core business, and getting to a point over the last 10 years or so where they're generating significant amounts of free cash flow. Now, free cash is the kind of cash that allows the company to do whatever it would like to do. So whether that be through M&A, paying out dividends, buyback of shares. These things are actually happening as well, and that's comes back to, if you like, a change in corporate attitudes. And these things have actually accelerated since the Lehman's episode of 2008. You know, through necessity, corporates have actually had to deal with this. And this is the thing that we believe is not yet priced by the market. It's the strong corporate fundamental health. It's the changing corporate attitudes. And these are the things that are really encouraging from our perspective to say, combined with valuations and strong fundamentals, we think this is the really key and strong investment opportunity for investment in Japan today.
Thank you, Michael.
Thank you very much.